What I'll do is I'll just quickly take you through a sort of a view from 10,000 feet, what we're doing at Vendetta on the Pegmont Lead Zinc project, which is located in Mount Isa, Australia. And I'll quickly touch on our mining team, what we did last year, and then where we'll be next year, what we've got lined up. So my background is I'm 20 years in the capital markets in the mining sector, running public companies. Previous to starting Vendetta, I was the executive chairman and founder of Underworld Resources. And what I liked about Underworld was, it was taken over by Kinross 36 months from when we IPO'd it. But the fact that we put $28 million into the ground and Kinross purchased it for $148 million. And every shareholder in that company made money, and essentially that's the model moving forward for Vendetta. Peter Valgaris, my business partner with Vendetta, brought us the project. He'd spent 7 years in Australia as an underground geologist with Newmont and Placer Mines, and then spent a further 7 years with Robert Friedland at Ivanhoe Mines in Mongolia on the Oyu Tolgoi project, where he was the underground mining engineer. Essentially, he did all the underground development there, sank the shafts for Ivanhoe. And David Baker is a chartered accountant. He was a treasurer at Ivanhoe. Whilst there, he raised, his team that he led raised $4 billion of debt equity and $4 billion of debt and $1 billion of equity. Doug Flegg is the former head of global mining sales for the Bank of Montreal. He was with BMO for 13 years. He led the team that did 200 mine financings, totaling $25 billion in sales. And Doug Ramshaw is a former mining analyst, and like myself, has been in the capital markets here in Vancouver with Pubcos for the last 20 years. Share structure, there's 75 million shares outstanding currently, 134 million shares fully diluted. That's a little fluid given that a lot of our warrants, primarily our 10-cent warrants from the financing we did last May, are in the money, and those are being exercised. Now, we've received approximately $250,000 from those warrants over the last 3 months. As we move the company forward, we expect to get more done. We would receive $5 million if they were all done, and they expire in 13 months. RCF is our largest shareholder. They hold 30%. They've maintained their interest from the inception. And Solitario Mines and Royalty, a New York Stock Exchange listed company, holds 10%. I'll just briefly talk on lead zinc. This is the coming market we've been talking about ostensibly since 2012. The problem was it was always around the corner. And this will be the third zinc cycle in my career. And really, it is here now, $1.25 zinc. We're in the middle of the cycle. We always thought that this was coming predicated on mine closures. And we've seen those mine closures happen. Now what we're seeing is there's a pinch at the smelter level on the concentrates. The canary in the coal mine that I like to use is the treatment charges and refining costs at the smelter level. Those are the costs that they charge the mining companies to process their ore. In a lot of cases worldwide at the smelter level, they're off by 50%. And in some cases in China, it's even worse. So there is a definite squeeze, and that's good for the mining companies, and that's what's essentially driving the price of zinc. Paradoxically, it's as simple as it is complex with zinc. There's a lot. We tend to look at things rather from under a microscope than through binoculars. As Eric alluded to, you've got to be able to take advantage of these high zinc markets. But what we've done is we model everything on 90-cent zinc and 95-cent lead. That gives us a bit of a leg up, because you will get a huge run, and I think the zinc price has a long way to go. But like everything, when existing feed comes through and supply comes onto the market, it will pull back. And then the key is, what is the sustainable price going forward. And I think with the zinc market, the key takeaway will be not how high it goes up and how long it stays up there, but what it pulls back to and what the sustainability is. Currently, you would probably do a bankable feasibility at 90-cent zinc and 95-cent lead. I think those numbers are going to move upward, but every 10-cent move can be tens of millions of dollars to the net present value of companies such as ours. I can say unequivocally, though, when the bottom was. And it was March 6, 2013 at 4:30 in the afternoon, because at the PDAC, which is the largest mining show in the world, I was given the zinc talk for the commodities. And if I'm giving the zinc talk at the PDAC, it's the bottom of the zinc market. Pegmont deposit, it was discovered in 1970 by Placer Dome. They were looking close to surface for oxide mineralization. It was then further drilled by various parties. We had a different concept. We looked at the old drill data. 2014, we picked up the project. In a lot of cases, they didn't drill deep enough, or the drilling was too wide spaced. So we were fortuitous that way. We were able to advance the model to the point where we found a new zone close to surface, and for the economics of a deposit like Pegmont could prove to be very paramount. The idea would be through our open pits to generate a payback on capital for ourselves or someone putting this into production within 2 to 3 years, and I think those open pit targets were well on the way for that. We've discovered a second lens. Pegmont was originally thought to be a single lens lead dominant system. Our thesis, we thought it was multiple lenses. We've hit those, and we thought the zinc grade would increase as we've gone to depth, and in fact it has. Lastly, what we did last year, we made a new copper discovery a kilometer away from the main ore body. Now, it's hosted in a completely separate package of rocks than Pegmont. It's a different style of mineralization, but it is a similar style to what's hosted in a deposit called Culthor and Osborne, 28 kilometers away. So we're going to follow up on that. It'll be interesting. We also see from a technical point a big alteration system, which is what the geologists like to see associated with that hole. We hit 3 meters of 3%. In and of itself is okay, but we're going to follow up next year on that. Advantages of Australia, a lot like Canada. It's one of the premier mining jurisdictions in the world. The infrastructure at Pegmont is world-class. It's akin to Sudbury or Timmins or the Northern Trends in Nevada. We've got roads, we've got power, we've got nearby smelters, and there's several mills in the region. Permitting is, I want to say, fairly straight ahead. I've made this comment before. Permitting in the mining industry is always problematic anywhere you are in the world. The question begs, is it manageable? It's certainly manageable in Australia. This is a mining district. The Dugald River, which would be one of the world's next big zinc mines coming into production, just to the north of us in Queensland, was permitted in 18 months, and that's a $2 billion capex. That was including their haul roads and their tailings facility. We're doing development drilling. We're not doing big step outs. We're drilling in between previous drill holes. It was a shotgun approach by the previous owners. We're drilling in between that and then adding to the resource from there. Deposits completely open, down dip and along strike. You can see the infrastructure. We're close to a smelter on the coast. 75 miles away, we've got the Mount Isa lead smelter, and then we've got two mills close by, one at Cannington and one at Osborne, and I can give you compelling reasons why both of those groups would like to have our feed for their operations. Our current resource, historic from the 43-101, we have 4.4 million tons of sulfide ore at 9% lead zinc and 700,000 in indicated for a total of 5.2. That doesn't include the 13,500 meters of drilling that we've done in the last several years. That will be added to this resource, which we expect to be out within the next 60 to 90 days. Our metallurgical test work will be released in approximately 30 to 45 days. Just quickly on our share price, since our financing, which we did last spring, has come free trading, we averaged 200,000 shares a day. Our market cap has gone from 5 million to 16 million, largely predicated on our news releases, which we'll be happy to go through with you at the booth, and any geological data and such. You can see where we put out news, we got both volume and an increase in the share price. This is the news flow going forward. As I mentioned, metallurgical test work is due out shortly. Mineral resource is going to be updated in Q1. And we're going to follow up on that new copper discovery, see if there's anything there. And then the Pegmont drilling starts again in March, April. We expect it to be an aggressive program. As Eric alluded to, we are in this zinc market. We want to capitalize on this cycle. And our environmental baselines are starting next year, and the target date for the PEA will be Q1 of 2018. Thank you very much.